We're live. Welcome to Protea Live. My name is Zane Stevens. I am the founder of Protea Financial. Happy Wednesday. A different day again for the third time. I did warn you guys about this, but I'm here. Yesterday was a busy day. I recorded three separate videos. So if you've been on our YouTube channel before, we have a series called Protea Conversations, where we've taken time to speak to some of our team members and just find out who they are, learn a little bit more about them. And it had been a while, and I wanted to do some more. We've been doing a really great job of Protea Conversations on our website, which is just standard interviews with business leaders, learning about them and what makes them special and how their leadership journey has gone. That is also part of our community outreach project, where for every single one of our interviews we do, we donate some money towards a charity of our choice. And we're working with guide dogs this year, and $100 every time we have an interview gets donated to them. Our hope is at least to get 10 a year, give $1,000 to the charity that it's supported, and every year we come up with another one. So if you've got any charities that you think are worth supporting, give it a shout out, drop it in the comments. We'll love to take a look at it. Generally speaking, we like to look at underserved communities. So that's pretty important to us. Guide Dog Association obviously helps a lot of people with disabilities, not just the blind, but it could be for any disability. And that's really, really important to us. So we continue our series, and as promised, today we're going to talk about financial statements. And I guess this is a bit of a shout out to business owners as well as shout out to accountants. The financial statements are really, really important. Financial statements are a snapshot of what your business looks like at a point in time. There are really three main financial statements that we all hear about. Those are the balance sheet, the profit and loss statement or the income statement, and the cash flow statement. But if we take it a step back, before we even get there, obviously we talk about it all the time that you need a really good bookkeeper that can pull that information in together. But the basis of accounting and the basis of those financial statements is a thing called the accounting equation. And the accounting equation is a simple formula of A equals L plus O. Assets plus liabilities, assets equal liabilities plus owner's equity. So your net worth, your net assets of your business are the difference between the money you invested and the money that you owe. And that makes up your net assets. And your net assets can be broken into cash, money people owe you, inventories, as well as fixed assets. So like I'm at a desk at the moment, I'm talking to you on a computer, fixed assets. They get depreciated over time. So that's sort of what you're trying to get into. And if you start understanding that accounting equation, it's the first step into understanding the balance sheet, because the balance sheet is a representation of the accounting equation at a point in time. And it is important. A balance sheet is a snapshot in a point of time. So it'll always say balance sheet at, and that is exactly what the balance sheet looks like at that point in time. Generally, you will do it on a month end with some sort of comparative. I like to compare it to the prior month. A lot of people like to compare it to the prior year. But at the top of your balance sheet, you'll get the breakdown of your assets. And it's important to sort of think about it in the most liquid current assets to the least liquid current assets. So generally speaking, you'll see your cash balances, what's in your bank account or your savings accounts, move on to your accounts receivable, money that's owed to you for sales that you've made, and then your inventories. Inventories obviously take a little bit of time. It takes a little bit of effort to sell them. They aren't that liquid. They can't quickly be turned into cash. Well, you hope they would be. It means your business is doing well. And then you'll go into your non-current assets, which generally speaking for most businesses will be your fixed assets, your buildings, your properties, your land, your equipment, office pieces, and they'll have some depreciation. There's obviously a lot more that can go into it, but that's the general picture. And that'll give you a total. It'll tell you how many assets your business has at a point in time. The second half of it needs to equal up to your assets. So if your total for your assets is $1,000, the bottom section should equal $1,000 as well. And that $1,000, which is equal liabilities plus owner's equity, breaks down the rest of the information. Again, from the most liquid to the least liquid, your short-term debt in terms of your accounts payable, money that you owe to people right now, then credit cards, and then you'll go into your long-term debts, your line of credit, your external fixed-term loans, and maybe some loans with investment partners. And then you'll go into owner's equity. Owner's equity will get broken down into a few separate sections, which is important to understand as well. It will show you how much is invested, so the money that you put into the business when you started it. It will then also take account any distributions or drawings that you've taken from the business over time. It will tell you how much profit you made in prior years. So there's this entry. Most accounting softwares do it for you, but when you're doing accounting 101, it's one of those entries. What is the first entry that you do at the end of the year? And that's sort of to take your total profit to what we call returned income or retained income or retained losses. And that'll show you your total losses or gains for all historical periods. And then you'll have your net income or loss for the current year, which will be your income or loss for this period. So you've got your total assets, you've got your liabilities, owner's equity, and that equals your assets. As you can see, equity is a little bit more complicated because it does break it down into the profit and loss statement. What profit did you make this year? And we can talk about that next. Those should all tie up, but it is, as I said, interconnected into the next financial statement, which is one that gets a lot of the praise. How much profit are we making? Let's go look at the profit and loss statement. Many people look at income statements in very different ways. The way I like to look at it is have a look at the current month versus prior year. I like to look at year to date versus prior year to date, and I like to look at a 12-month rolling. Sometimes comparative, sometimes just to see the 12 months, whatever works for you. Those are always great. If you've got a budget or a forecast, comparing the period or year to date against that budget is really important. It's good to assess how well you're doing versus your thought out process. Are you doing better? Or are you doing worse? And why? So in an income statement, what you'll see is at the top of it will be your revenue. How much money have you made? It'll then give you the cost of goods sold or your cost of revenue. And that'll be broken down, which will then total to a gross margin. Your gross margin is how much money did you make on each sale. So if I sold that widget for $1, what was the cost to manufacture it? And how much profit did I make on that? Afterwards will be followed by operating expenses. I generally like to see administrative, then marketing, maybe salaries and wages in a separate category as well. But anything that you are spending money on to run your business should be shown in that type. That'll get you to an operating profit, and then you'll have a few line items below the line. Interest expense, interest income, you've got your depreciations there, and you'll get down to your net income. When you're looking at a profit and loss statement, one thing that you'll probably hear people talk about it a lot of time, what is your EBITDA? One of those nice accounting words. Finance people love it as well, but it really is earnings before depreciation, interest, tax, and amortization. Bunch of accounting stuff, effectively taking out costs so that you can truly see what the operating profit of your business is before those financing costs, the allocation of your fixed assets. It's one of those variables where it's like, hey, if we take out all the other stuff, other things that affect our cash flows, what will your business be doing? And people will do that to compare businesses with similar business to each other, because hey, you might have paid X for your fixed asset, I paid Y for fixed assets, so it's not comparable. I might have had equity, you might have had debt, so let's take out the interest. We can't compare it. Let's just purely see it based on sales, cost of goods sold, and the real costs to actually make the wheel turn. How much profit is your business making? Pretty important variable that people like. I like operating profits. If that includes a little bit of taxes here and there, if it includes a bit of interest, I'm not too concerned, but I understand why we'll take it out as well. It's up to you. The last statement that you do need to understand is the cash flow statement. This one is probably really more important than you think it is, but I know it can be really difficult for people to understand because they talk about all these weird things like operating, it's cash flow from operations, cash flow from financing, cash flow from investing. And to simplify it really is how much money are you making from running your business on a day-to-day basis. Let's talk about that operating income we just spoke about, adding back the depreciation, interest, anything that you haven't actually paid. I've still got some payables. You haven't received some of that income. Let's pull it in and let's see how much cash we're actually generating from the business. Did we make cash this month or did we have to pay cash out? And looking at that over for a monthly period, 12-month period, get a sense of how much cash flow your business is generating. On top of that, you've got that cash flow from operations. Where is the rest of your cash flow coming from or going? So from the financing side, it is, have you made any debt payments? Have you had to take any debt on board? Is there any investment money coming in? Those types of things. Let's see, If I have got a shortfall in operating income, where's it going? If I'm making operating income, is there a place that I'm actually using that to pay back debt to improve my balance sheet? The last section of it is investing side, and the investing side, we're really talking about, I need some new capital assets to run this business. Hey, I've got this new piece of machinery that will reduce our overall production costs, but it does take cash flow. How did that affect my overall business cash flow? And then afterwards, it'll just show you opening cash for the period, closing cash for the period, and what the net movement is. And that net movement is from your operations, plus minus from financing, plus minus from investing, just to get a good sense of it. I know the cash flow statement can be confusing, but understanding how much cash your business is actually making is really, really important. It's important to know where your cash went so you can make better decisions on where your cash goes. All of these financial statements are just a snapshot, and that is very important to understand. As accountants, it is our responsibility to make sure that we're providing our clients, if you're outsourced or working internally, with financial statements that are accurate and complete. Business owners need to use these financial statements, the balance sheet, the profit and loss statement, and the cash flow, to understand what is going on in their business, the historicals, the point in time as it would be for a balance sheet, so they can make some better decisions about what they're going to do going forward. They'll use that balance sheet to understand, where is their cash tied up? What does their assets look like? How much is tied up in AR? How much debt do I owe people? And how much inventory do I have? Working capital can be a big portion of cash flow tightness for businesses. That balance sheet gives you a point in time to see the health of your business. They need that profit and loss statement. Like I mentioned, I like to look at the current month, year to date, and a rolling 12-month period. It provides the people that I work with good indicators of what they're doing in terms of financial performance related to their sales, their ability to reduce costs of those sales and the gross margin situation. Are you doing better or worse than a prior period? It gives them a sense of where they are spending money in which areas on their business. I like to split them between general operating expenses and marketing expenses. And then it gives them a total picture of how much profit they are making. The last one, which many people forget, and it really is the responsibility of accountant to better explain this to our client, is the cash flow statement. The traditional cash flow statement is confusing. It uses weird words like operating activity, investing activity, and finance activity. But really, all it is doing is giving you a snapshot of how much cash did your business generate, how much of that cash hasn't come in or hasn't gone out the door yet because you still need to pay some bills. Have you been using outside money or to come in and feed your cash flow, or have you been paying down the debt in terms of finance activity? And have you used any of your cash flow for investment? Getting the picture of what you've done with your cash flow year to date and rolling 12 months will give you a good sense of probably what you're going to do in the future, unless you make adjustments to sales, cost of goods, or operating expenses, which you learned about in your profit and loss statement. Those three combined, understanding your financial position, the profits you're making, and how you're using your cash flow, will give you good information to make better decisions for your business, as well as plan for the future. So as an accountant, we need to provide accurate financial statements on time to our clients to help them make those good decisions. Financial statements are important. It's something that, is not understood enough. I try to share it on my LinkedIn page as much as possible. Make it your responsibility as the accountant to help your clients better understand their financials. And the first step of doing that is make sure they're accurate. The second step is making sure that they're on time. I'm pretty lucky today. My whole team is here my whole US team is here in our office in Nevada. They're busy in training. I've got about 30 minutes and I'm going to head over and spend some time with them, grab some lunch, have a few meetings. I've been really excited for these couple of days that I have with them. I'm very grateful for it. And I'm really grateful for all of you watching and paying attention. And hopefully you learned a little bit something from me. If not, I'll try to do better. I'll try to simplify it even further. You just let me know what you want to hear about. Thanks for spending time with me. Till next time.